Hi, everybody. Thank you for joining us for our final installment of our Managing Farm Risk webinar series. Today, we're going to be talking about financial risk. Let's go ahead and introduce our presenters, and then I'll tell you a little bit more about our associated course. Ed, do you want to introduce yourself?
Yes, I'm Ed Ferris. I'm with Purdue Extension in Huntington County. I'm an ag and natural resources educator.
Thank you. And Michael?
Michael Langemeyer, Professor of Agriculture Economics here at Purdue, the West Lafayette campus.
Perfect. Thank you. So all of the work that you're going to see today is based on an NCERME grant that our team received. We'd like to thank them for their support. Next slide, please. Perfect. And if you like what you're seeing in this webinar series, we have an associated course that you can enroll in, and it's a deep dive on the 6 pillars of farm risk management. We go into the 6 pillars that we cover in our webinar series, but you'll get a checklist. You'll get a lot more in-depth information than you get at these 1-hour webinars. But without further ado, I'd like to thank Ed and Michael for presenting today. I'll turn it over to you two.
Thanks, Renee. Let me start by saying we saved the best for last. Financial risk. This is a topic that I've spent quite a bit of time on during my career and find it fascinating. So hopefully we can share some of that fascination with you today. There's 3 basic components to financial risk. We're going to discuss these in order. The first is the cost and availability of debt capital. I will be discussing that briefly. And then Ed Ferris is going to talk about the ability to meet cash flow needs in a timely manner and absorb short-term financial shocks. That's obviously a very important topic in today's environment where we have a lot of uncertainty, relatively high input costs, and certainly no guarantee that crop prices are going to stay as high as they are. And so even though 22 looks like it's going to be a fairly good year, depending on weather, of course, we need some more rain in most of the Corn Belt. But it looks like it's going to be a fairly good year. If we do get those rains, 2023 could be pretty tight margins. And so that's a very important topic, and Ed will be discussing that. And then I'll talk about the ability to maintain and grow equity. So talk about more about the growth of the farm and how that might be related to financial risk. It's very important to realize that the financial statements are important to everything we're talking about today. This is not a discussion on financial statements and financial analysis, but in order to really manage financial risk, you need a good set of financial statements. And I'll talk more about what I'm talking about there. Before I leave this slide, Ed, I would like to point out that the Center for Commercial Agriculture has a series of publications on financial statements and financial analysis. And so when I'm referring to a financial statement or a specific ratio, there's a lot more information on that website that's available for free. And so I encourage you to check out the information on financial statements and financial analysis. Let's go to the next slide, Ed. Oops, went backwards there. So to address the 3 basic components of financial risk, a good set of financial records is essential. These records provide the information needed to evaluate past performance and competitive advantage and to plan future strategies. What I really want to summarize by this slide, if you don't have a good set of financial records, it's very difficult to think about competitive advantage, what your firm does well, because you don't have those financial records to back it up. Also, if you think about planning future strategies, it's very difficult to figure out whether you need to add 160 acres to your farm, either by cash renting, share renting, or purchasing, if you don't have a good set of financial statements. And so what do I mean by records? Records could include cash transactions. That's very common for farms to collect information on cash income and expenses, and that would be both on the farm and off the farm. Both of those are important to track, but also inventory values. And so here we're talking about a balance sheet. So a good balance sheet that has inventory values for supplies, crop and market livestock, breeding livestock, machinery, buildings, and land. And usually when we're talking about inventory values, we're talking about market value. So marking these assets at value and evaluating where we're at in terms of financial assets and financial liabilities. So let's briefly review the financial statements before we continue here. These are the four main financial statements. Ed's going to be talking about another financial statement called the sources and uses of funds statement, but that's really a statement that uses these four statements. And so a balance sheet is a snapshot of the financial position of the business. Most firms have a balance sheet at the beginning of the year that they use for their lenders and other purposes. A cash flow statement is exactly what it says. Here we're keeping track of cash income and cash expenses, both on the farm and off the farm. So such things as loan payments, family living, capital purchase are included in this cash flow statement to see if our cash flow coming in is large enough to cover the cash flow going out. And so tracking that cash over a period of time. Most farms will do this at least annually. I encourage you to do it more frequently in that, so you can really see where you're at a given time, to see where you're at in terms of ability to repay operating debt and term debt. Going one step further, using the cash flow statement, the balance sheet, we can create an income statement. And this is important because it calculates accrual net farm income. And so net farm income that is adjusted for inventory changes. This is a way to capture the true profitability of the farm over time. And so if you're not calculating accrual net farm income, I encourage you to check out the publications on the Center for Commercial Agriculture website and figure out how you could do that. It's not that difficult to use a balance sheet and cash flow information to come up with accrual income statement, and the information is on that Center for Commercial Agriculture website. There's also the statements of owner's equity. Not every firm, small business, including farms, uses this statement, but this statement can be very valuable because it really traces why your net worth changed over time. And that may sound like, well, I know why my net worth changed over time. Well, not really. If you're not creating the statement, you probably don't, because there's two sources, very important sources that you want to disentangle in terms of growth and equity over time. One of those is retained earnings. And so how much of your net farm income are you keeping in the business and using that to grow the business? And so that's retained earnings, the amount of money, not of net farm income you're keeping in the business. The other one is change in land values. Recently land values have increased dramatically. Well, that's had a positive impact on net worth. And so if farm wants to know whether the net worth in a particular year was due to retained earnings and or changes in land values, and hopefully disentangle those over time. The lesson here is if a farm is going to continue to operate long term, it needs to have some retained earnings. And there needs to be some retained earnings to help grow. It's very difficult to spend the increase in land values. Yeah, you can borrow money on land, but that's not money that's readily available to grow. It's the retained earnings that are important for farm growth. And so that's why this statement can be very valuable. So let's move on to the first component of financial risk. This is a very, very short section. I just want to emphasize two or three things related to the cost and availability of debt capital. And so again, the financial analysis is very important. Financial statements and ratios provide information to evaluate past performance and competitive advantage and to plan for future strategies. It's also important to evaluate the cost of debt capital and the potential variability in the cost of debt capital. And we're in an environment right now where there's a lot of uncertainty related to interest rates. And so this is becoming more and more important. And interest rates have two impacts on farms. One is obviously they increase the amount of debt payments. They increase the debt payments because we have to pay more on that borrowed money, both short-term, intermediate term, and long-term. And even if we have fixed rates on some of our long-term assets, eventually you're going to be paying more for those assets if interest rates stay high. And so that's one source of financial risk. The other source is higher interest rates have a negative impact on land values. And so it's going to be very interesting to see how increasing interest rates plays out in the near future in terms of its impact on land values. And so, that's not something we're seeing right now, but if interest rates continue to climb, we may see some impact on land values related to higher interest rates. And so let's move to the next slide and talk about this in a little bit more detail. So favorable interest rates often accrue in those with strong historical and projected financial performance. That's another reason why you need to track use financial statements to track financial performance so you can validate what your performance has been and perhaps get a better interest rate. Farms with characteristics of a strong financial position tend to have lower interest rates, decreasing our exposure to this risk. Another aspect of interest rate risk is the possibility of a general increase in interest rates. We've talked about that. When making capital purchases in particular, a farm should examine the sensitivity of these decisions to higher interest rates. And so not only look at the current interest rates if you're buying a tractor, for example, look at what happened to those debt payments if interest rates would increase 1%, 2%. It's another reason why you want to take a strong look at fixed interest rates, is that would eliminate that chance of a higher interest rates. But obviously, if you have a fixed interest rate in this environment, you might be paying more than a variable interest rate. And so this issue has really popped here in the last year, and it's going to continue to be important for the next several years. Finally, we want to look at the relationship between return on equity, return on assets, and the interest rate on debt capital. This is a little heavy lifting, so let me define some terms here. Two of the most important measures, financial ratios, are return on assets and return on equity. And so I'm just going to talk about these in general. If you want more information on how to compute these using an income statement and a balance sheet, that's the information you would need. Again, I would refer you to those publications on our internet site. Essentially, return on assets is exactly like the name implies. You're looking at the rate of return on all the farm assets. And so if you own $1 million of farm assets, what is your rate of return on that $1 million? Is it 2%? Is it 3%? Is it 4%? And so on. Return on equity, on the other hand, is your rate of return on just the net worth portion. So let's say you have $1 million of assets and you have $750,000 of equity. And so it's the rate of return on that $750,000 of equity. Is it 2%, 3%, 4%? Borrowing works. And this is always easy in hindsight. It's very difficult when you're looking ahead whether this is the case. But borrowing works in general if return on equity is greater than return on assets. In this case, can increase return on equity by borrowing more. But I mentioned here, be very careful because one of the largest sources of risk on a farm is related to debt. Debt works for a farm because it allows you to grow and buy some assets you couldn't buy, to increase productivity, to expand the size of your farm. But you have to be careful because debt exposes you to debt payments, and it makes the replacement, your ability to replace assets and to repay debt more difficult. And so you got to be careful when you borrow money here, and particularly in this environment. But in general, if return on equity is greater than return on assets, we can increase return on equity by borrowing more. When does borrowing not work? And again, this is more in hindsight. We always think that when we buy something, we're going to make money on that. That means return on equity is going to be higher than return on assets. That's not always the case. And so in hindsight, if we see that return on equity is less than return on assets, here we're losing money on borrowed funds. And so in this case, we need to be extra cautious in terms of borrowing money and try to reduce debt if we possibly can and or improve operating performance. Improving operating performance would increase the profit margin and increase the return on assets. And so that's basically a summary of our first concept. Ed's going to now talk about the second basic concept.
Yes, thank you, Michael. So moving ahead, we'll talk about the ability to meet cash flow needs in a timely manner and to absorb short-term financial shocks. And as Michael said, this is an environment that we're in right now with high costs and to produce commodities, or no matter what type of business you're in agriculture, the cost side is something very important to consider. And so thinking about the financial statements and ratios to provide the information needed to evaluate your past performance and competitive advantage, and thinking about your future strategies. Where is your business headed? What is there people coming into the business that or potentially that are interested, and how do you plan for those things that they're coming ahead, and also what opportunities are out there. That type of thing is important as you're looking at your financial situation. Cash flow needs can be measured by comparing sources of funds to uses of funds, and this is I know something that I really appreciate. Working with Michael in the last few years, I've become a little more familiar using this. I had a prior career as a banker, and I don't think the lenders that traditionally don't maybe talk about this statement as much. And I think it's good to look into this if you haven't looked at it in the past. It's just a different look of your financial situation, and you're summarizing your net cash provided by operating activities, investment activities, and financing activities. So you're reconciling the information in the income statement, balance sheet, and cash flow statement by going through this sources and uses of funds. So you're basically starting with your beginning cash balance, and you're adding the net cash from operating, investing, financing, and to come up with your ending cash balance. So we'll go ahead and look at each of these areas, the operating, investing, and financing, and we'll talk about the operating activities. This is really the cash farm receipts and net farm income for the sources, and obviously the uses are these cash farm expenses, your owner withdrawals, which could be like living expenses for each owner, how much that's taken out, and also income and self-employment taxes. And within those owner withdrawals, there may be funds set aside for things like health insurance. There could be to go into retirement, things like that. In most years, in terms of operating activity, sources will be greater than uses. So you would hope that there's a positive net cash from your operating. If your farm's not operating at a profit, obviously that's going to be hopefully a very short-term situation, and that can be corrected. So we want to go ahead and then talk about the next area is the investing activities. And this is really your asset sales and purchases. And in most years, the investing activity sources will be less than uses. In other words, you're going to have more asset purchases than what you're going to have sales. And you often examine whether net cash from operating activities and net cash from financing activities are large enough to cover these purchases that you have. And if they're not, the cash balances will decline. And going ahead, then we'll look at the financing activities for loans received. And this is something that does change quite often with businesses. What are your if you're growing, in terms of financing activities, your sources are the loans you received can be larger than the uses. And so this depends on how quickly your farm is. If you're buying, have had some opportunities to buy land, or you've purchased some equipment, or additional land rented for your grain operations, or if you're a different type of, if you're in a livestock business and where you've expanded your herds for beef or dairy or something like that, you may have a situation that's different than when you're growing. It's going to have a different look than other years. When you're as holding steady, when in this case is so this is a case by case situation. Sources and uses of funds then state we're continue talking about, then thinking about this as the change from the beginning to the end of the year. And there's really questions that we want to answer are, is the net cash from the operating activities, the net cash from the financing activities large enough to cover your capital purchases? And so what happens if it's not, then you're going to see a reduction in your cash and your ultimately your working capital. And so if they're not, do we have enough cash to pay for the capital purchases? So this is really what the source and uses of funds statements will really look at. And moving ahead, then we talk about, I mentioned working capital, and this is something, if you're working with a lender, they tend to talk about quite often, and making sure that your business does have enough liquidity to meet the financial obligations that come due without disrupting normal operations. And you can think about this in different types of ratios. There is the current ratio, which is the current assets divided by the current liabilities, or just, working capital. Obviously, the working capital is the current assets minus the current liabilities. And then you divide that by the value of farm production rate. So that would basically be your gross income that you would have and from the farming operation. So looking at the current ratio, how you calculate that, I mentioned that it's above 2 is what a guideline is, what's recommended. And obviously if you've in a situation where you've made a lot of capital purchases, if you have put a down payment on some land, if you're in a dairy and you've bought a lot of, you're expanding you've bought some replacement cows or something like that, then you may have a situation where your current ratio is not to the 2 to 1. So you have to think about that it's going to be more difficult to meet cash needs. And in just some years there's obviously we're in the outlook right now, if you're in the grain business, with the way the commodity prices are, you should be profitable, even though the expenses are higher. But there could be some years where there is lower income, and that will greatly affect these ratios. And so thinking about liquidity and what a good guideline is for this working capital to value of farm production, if you think you have, let's say, $1 million in working capital, and you have your value of farm production, the income that you're producing from your farm, if it's a 3 million, then you're going to be in that range of that, above in that 35% range. So a ratio below that 35% is going to make it more difficult to meet cash in a low income year. So these are rules of thumb to keep in mind. So now I'm going to switch it back to Michael, and he's going to talk about this whole situation with equity and how it's important to continue to grow that when you're making your plans for financially.
Yeah, so let's talk about the ability to maintain and grow equity. This is our third basic component of financial risk. So let's start by talking about farm growth. There's a lot of motivations for farm growth. We grow the farm to garner economies of size, to help pay for expensive machinery. For example, we buy a larger tractor, it's probably going to take more acres in order to productively use that tractor. And so that's one of the reasons to grow. Also, to provide opportunities for more fully employ the skill sets of the managers. Maybe we have somebody coming back to the farm with some really good skills in the finance area or technology area, HR area, whatever that may be. And to more fully utilize their skills, we're going to grow the business. We're bringing in family members. And so there's really good reasons for a farm to consider growing, but we have to be cautious. That's where the financial risk comes in. Typically, when we grow, we use both debt capital and equity capital. Equity capital is that retained earnings, those retained profits. We use that to expand the operation, to rent additional acres, to buy machinery, to build buildings, construct grain bins, for example, to purchase land. That's part of what we use to buy those assets. We also use debt capital. And the reason why we talk so much about debt in this financial risk section is debt can really work. I'm a firm believer in using debt for a small business to grow. It can be very valuable, but we have to be cautious. We have to make sure that our farm is making a large enough profit that we can actually repay that debt. And that's why when we buy an asset, we want skin in the game. Even if we could find a lender, which you can't, but even if you could find a lender that would borrow 100% of the money to you to buy an asset, you wouldn't want to do that because it increases your risk dramatically. If for whatever reason you face 2 or 3 years that are not profitable, you won't be able to keep that asset. And so using this combination of debt and equity capital when you buy assets is very important, and to really try to not minimize the debt, but try to make sure that you're using a portion of every purchase, you're using your equity capital in addition to the debt, because that's going to give you more cushion if profitability is not as strong as what you were projecting. So how much debt can a farm carry? That's a big question. I actually have a publication on that on the Center for Commercial Agriculture website. These are the factors to consider: current liquidity and solvency position. If you have strong liquidity, very low solvency, which is measured by the debt to asset ratio, that would be all debt, short-term and long-term, divided by all assets. If we have a very strong solvency position and liquidity, you can borrow more money. The bank is going to be willing to borrow money to you. Repayment capacity, if it looks like from the lender's standpoint that you have a lot of ability to make payments. Let's say you're quite profitable as a farm, using long run averages, and so that's going to make it look like you have better repayment capacity. You probably do have better repayment capacity in that situation. You're going to be able to borrow more money. Also, the length of the repayment period and the interest rate. What I want to say here is you need to match the length of the repayment period to the life of the asset. And so if you think a tractor is going to last 10 years, try to get a 7 to 10 year loan rather than a 3-year loan. And so that's what I mean by length of repayment period. And even if you think you could afford to use a 3-year loan to buy that tractor, really hesitate to do so because if you do have a hiccup in your profitability, it's going to be more difficult to repay that loan. And so try to match the length of the repayment period to the life of the asset when at all possible. Also, the interest rate, if the interest rate's relatively low, you can borrow more money. Stability of income. A farm that has, for example, contract finishing is a big part of their business. Contract hog finishing is probably going to have an easier time borrowing money than a producer that was independent hog production, for example. So that's one example. Skill and experience of the operator. If the operator has a lot of experience and if they've worked with a lender for a long period of time and they've never not made a payment, that's going to work in your favor. Finally, risk aversion. This is not a time when we're going to evaluate your risk aversion, but there is risk aversion quizzes out there. In general, someone that's real risk averse or who does not like variability is going to borrow less money. And so some people, you can't sleep very good at night if they borrow a lot of money. And so if you're one of those, you're probably not going to borrow as much money as someone that really doesn't worry that much about it. They're confident that the farm is profitable enough that they're going to be able to repay that debt. Another very interesting topic, at least in my mind, and I think this is a topic that I've been really preaching to everybody to try to track. And we actually do some financial workshops, Ed Ferris and myself and some others in Extension that actually cover all of this material, financial statements, financial analysis. Maybe we'll offer one again next winter. But one of the topics we do talk about is repayment capacity. This is looking at our ability to repay debt. And this is one of the things that lenders look at very, very closely. That's one of the reasons why they ask for information from you. They'll ask for some information related to your historical cash income and expenses, at least historical Schedule F, for example. They'll also ask for information on a balance sheet. That's kind of a minimum level. And what they're trying to do, they're trying to gauge whether you're going to have enough cash flow to repay debt, and just as importantly, from your standpoint, to replace depreciable capital assets. One of the things I've seen in agriculture over my career is most farms have the ability to repay debt. What they don't necessarily have is they're not generating enough cash flow to timely replace depreciable capital assets. And so we want to examine whether our cash flow is big enough to repay debt. That's what the lender is focusing on. But we also want to know whether our cash flow, and again, this is over a long period of time. There might be a year where you can barely make debt payments, yet alone have any extra cash flow. But over a long period of time, do you have enough cash flow on the farm to replace your tractor, or replace your planter, and possibly expand? Again, you're going to use cash flow to replace assets, but also expand, to buy bigger tractors, to buy bigger planters, to rent additional acres, to buy land. And so this is where this repayment capacity measures are very, very important. And so I talk about this something called replacement margin. This margin is looking at a farm's ability to repay debt, replace depreciable capital assets, and to expand. If you have a positive long-run replacement margin, this signals that your farm has generated enough cash to repay debt and replace assets and grow. On the other hand, if the replacement margin is negative, this means you probably have had trouble in the past replacing assets, and unless you do something to increase your efficiency on the farm, that may involve expansion, that may not, you're probably going to continue to have difficulty. And so we want to look at this replacement margin both from a historical standpoint, but also from a projection standpoint. If we're buying a tractor, for example, think about buying a tractor in 2022, are we going to be able to pay for that tractor? Go through your cash flow projections, see if you have enough money to repay debt, see if you have enough money to buy that tractor. Do you have some funds that you can make a down payment on that tractor? Do you have some funds that to repay the debt on that tractor, along with all the other needs that you need, cash flow needs that you have? And so make these calculations and determine whether you can pay for that tractor in a timely fashion. This leads us to something that I think is very important in today's environment. This is a topic that we've discussed before in this series. This also comes up when you're talking about human resource risk, for example, is this whole idea of contingency planning. When you talk about human resource risk, here we're talking about contingency planning in case one of the operators has a health problem, or one of those, or maybe the operator won't even be able to work in the future, at least for a while. What's your plan? How are you going to replace that person? Here we're talking about contingency planning for cash flow shortages. Let's say we're looking at 23, it's later in 2022, and you're developing your cash flow for 23, and things look really tight. Well, then you need some contingency plans. What would I do if my cash flow is tight? How would I ensure that I'm able to repay my debt? What do I need to do today to ensure that I could repay my debt in late 23? This is what we're talking about. And so not just making one plan in terms of a cash flow, making multiple plans and thinking about that worst case scenario. If corn price is a lot lower than projected, looking at the futures in 2023, it looks like corn might be around $6, for example. What if it's $5.50? How would I be able to repay my debt? And if not, how would I repay that debt? Do I have enough working capital that I could draw down my working capital, draw down my cash to repay that debt because my cash flow is not big enough? These are the kinds of questions you're asking with these contingency plans. And again, in this environment we're in, this is an absolute must to think through these and see if we have enough cash flow needs to repay debt and to replace assets. So some questions. I always think it's good to pose questions. Will our farm be able to cover term debt payments if crop prices are 10% below projected price? I usually look at the futures price and then I look at maybe 10% below and 10% above. You may want to widen those a little bit, but that's a pretty large change if you stop to think about it. If you're looking at $6 corn, 10% below would be $5.40. 10% above would be $6.60. That's a pretty big change in crop prices. And so this is an example of how you could do this. And so what would happen if prices are 10% below? So that's a very important question. Could I still make those payments? What would I need to do to make those payments? Because I don't want to not make those payments because that gets me in trouble, and I might have a chance of not getting an operating loan the next year if I can't make these payments. You also want to look at the positive side. And so don't just focus on the negative. If crop prices are 10% higher than projected, what could I do with these additional funds? Should I use this to increase my working capital? Should I repay more debt than I was scheduled to repay? Be careful with that, but that's certainly one option, and a lot of farms do that. In 21 and 22, we saw farms that are repaying more term debt than what was actually owed, or purchase assets. And so it's just as important to look at this positive side as the negative side. And so now I want to kind of conclude here before we open it up for any questions you might have, is talking about a couple current challenges. And so let's go to the next slide here. So questions to think about. What would happen if input costs remain high next year in 2023, and at the same time, crop and livestock prices decline? This is a very real possibility. And when I talk to farmers and reporters, I always talk about this with them, and they talk to me about this, is we're facing a possibility of a cost price squeeze. It's not that we haven't seen this before. Certainly from 14 to 19, we were in a situation where input costs were still relatively high, coming out of 2007 to 2013, a fairly good time period for production agriculture. Input costs were relatively high, including cash rent was still relatively high. It takes a while for cash rent to come down in the face of lower income. We were facing a cost price squeeze. And so we face this periodically. All I'm saying here is it looks like 23, we might be back in that situation. So we need to plan accordingly. And so we need to think about our liquidity and solvency in particular, making sure that that they're solid, and we don't empty our cash accounts. We don't sell all our crop this year because we're going to need some cushion going into 23, and that's where the liquidity and the solvency comes in. Another potential problem here, and this is with the high inflation environment, as I remember the 1980s, I was an undergraduate student, but I was still helping my father on the farm, helping him. Helping is probably not the right word. He made the decisions, but he talked to me about it, and so I was discussing with him making decisions in an inflationary environment. It's really difficult to make capital purchases in the environment we're in because you don't know where the input costs are heading. Are input costs going to be flat in 23? Are they going to be 5% higher? Are they going to be 10% higher? Are they going to be lower in 23? It's very difficult to make decisions in this environment. And yes, I know that agriculture is risky by nature, but we're at a level of uncertainty that we haven't seen for a while because of the high inflation. And so my advice here, and this is kind of a broad advice, but proceed with more caution than usual, and also do the contingency planning. Plan for the possibility of lower projected prices, because we're in an environment where prices move rapidly from week to week, and they can move rapidly from year to year. Obviously, they always do. And so proceed with more caution than usual, and use a what if when you're buying assets. Ask questions like, what if the interest rate increased 1% or 2%? Can I still make that land payment? Can I still pay for that tractor? Can I still effectively repay my operating loan under that environment? Can I repay that debt if corn price is 10% lower, corn and soybean price are 10% lower than what the current projections are? And so ask questions like that in the current environment. And so with that, I'll turn it back over to Renee. Oh, I forgot this slide. Further reading, this is a very good publication that is available for free download. It's Extension Risk Management, Education Risk Management Agency, Introduction to Risk Management. Many of the things we've talked about are in this paper. However, we've went in more detail on the financial risk than this paper does. And for that, I would again refer you to the Center for Commercial Agriculture and look at some of those publications of financial statements and financial analysis. Now, I'll turn it back over to Renee.
Thank you so much, Michael, and Ed. That was great. I love how you talked about some current issues as well, because I know a lot of farmers are facing some issues right now related to financial management. I just want to take another minute and highlight our course that is open for enrollment. If you were interested in this program and you'd like to dive deeper into risks that your farm is exposed to, you can visit that link and sign up for our course. Otherwise, this concludes our 6-part series of our Managing Farm Risk webinar. We appreciate you joining us, and we will see you soon. Thank you so much.